Good morning. Good morning. क्या खबर? All good? Hi, good to see you. Alex, Abhishek, Birendra, Chaitanya, Dipalok. Hi, Karthikeyan, Yagnesh, Piyush. Great. Super. So let's continue. Jitendra Joshi, Kishore, Mamta, Mangesh, Nitin, Prajakta, Priya, Rakesh. Great. Suchit Saxena. Great. So let's begin. So this week we are discussing inflation. Sorry, Katha is week. This week is on interest rates, and then we will move into growth and other parts in the following week. Super. So this is the second part of the series on interest rates. Perfect. And let's get started. Let's get started. Super. So let me ask you something honestly. Dekho, when RBI increases interest rates, how long do you think it takes for the economy to feel the impact? कब होता है? Does it happen immediately? Does it take a few weeks? Or maybe after a few months? क्या लगता है? लिखो, write your comment in the chat box. Okay. Karthikeyan says not immediately. Yes, there is definitely a lag. Good. Sometimes it takes a few weeks. Perfect. Few months. Absolutely. So, in general, because moment there is a rate change, the newspaper starts to covering it the following day on the headlines, and many people, gullible people, clients, investors might assume it's immediate. Rates go up, markets react, economy slows. Simple. That's what people would generally think. But that's not how it actually works. Let me give you a real world example. Dekho, suppose RBI hikes rates today. Does your client's EMI change tomorrow? No, right? Because, and does a business immediately cancel its expansion plans? Definitely doesn't. And does the demand suddenly collapse? Of course not. So if nothing changes instantly, then what is really happening? The truth is, interest rates change don't act like a switch कि on off कर दिया. They act like a slow function, like a wave, like a ripple. They start at one point and then slowly move through the system. First, it will move through the banks, then through the loans, then through businesses, and then through consumer behavior. And only after that, into the real economy. And this entire journey takes time. Sometimes it may take 6 months, sometimes 12 months, sometimes even longer. Now, markets, on the other hand, don't wait for this full impact. They start reacting much earlier, okay, based on what they think will happen next. Perfect. So today's session is about understanding this invisible journey, about from the time the rate change happens, how long does it take, and how does this movement pass through the system to the real economy, how a simple rate change travels through the system, why sometimes the impact is delayed, and why markets behave the way they do during this period. Once we understand this, then you stop expecting instant reactions. Perfect. So let's get started. Are we all ready? मेरा वॉइस लो आ रहा है? क्यों? मैं तो एकदम नॉर्मल वॉइस में ही बात कर रहा हूँ, the way I do. All right, Karthikeyan says I am able to hear you as usual. All right. Okay. Chalo. Give me a 30 seconds. Let me download my presentation deck and we will get started. Perfect. Let me know once you are able to see the presentation deck. Visible है अभी? Okay, perfect. Thanks. So what's this pipeline? How does the market monetary transmission move through the system? Okay. So generally, what most people think is there on the left, like RBI ने rate change कर दिया, उसके बाद economy react करेगा, market react करेगा, and simple and immediate. But the real pipeline, the reality is different. So how does it work? So RBI changes rate, the system absorbs it, then they adjust themselves to it. Some part of it gets transmitted in some point in time, and then they start to react. This is not a switch. This is a slow pipeline transmission. Okay, so it is a staggered impact. The point is, rate change is never an immediate transmission. It is a staggered impact. So there are 5 layers to this transmission. At the layer 1 is the policy change from RBI. So this is not an impact. It is just a signal. RBI rate change doesn't bring an immediate impact to anything. It is just a signal. Then comes the financial system response to it. Then it transfers into the credit channels. Then the behavioral adjustment. And then finally at layer 5, you will have the real economy adjusting to it. Perfect? So let's see how these things happen and are there any bottlenecks in the layers. In the layer 1, when the signal happens, so the stance also could change from hawkish to dovish, or from dovish to hawkish, or neutral and something. So there is a stance as well. In the layer 2, banks don't instantly pass it on. Why does it happen? Because there are existing loan books which take time. There could be cost of funds which are already locked up. And there are competition between banks which actually might or might not allow them to change interest rates immediately. And at layer 3, at the credit level, the transmission is sometimes partial or sometimes many a times delayed. It may take months, and definitely not in days, for lending rates to adjust. EMIs do change, but loan approvals do slow down or pick up, but all of this takes a lot of time. So the most ignored layer is the layer 4, which is the behavioral adjustment. Layer 4 is when the consumers and businesses, they don't react immediately. Behavioral change, as we all know, takes a lot of time. It's a very slow process. And this businesses delay capex only after they take time. They may take 2 quarters, 3 quarters, and then consumers also gradually change their spending pattern, which can be even delayed by 2 quarters, 3 quarters, and then slowly the real economy impact starts, where the demand would undergo a change, the inflations would react, and earning adjustments would happen. This final drop is exactly where macroeconomic data finally starts to show the impact. So, is there a lag? Answer is yes. So what are the various types of lag? The first one, we call it the recognition lag. उसको recognize करने में ही lag है. RBI identifies inflation issue, but the real economy is far from that. There could be a policy lag. RBI sometimes doesn't act on time. Sometimes there could be a transmission lag. Banks and systems don't adjust as much. And then there could be behavioral lag. And finally, the impact lag. The economy shows results, but with a delayed impact. This total transmission could be anywhere between 6 months to 18 months, depending upon the level of sensitivity. And this is where many of us catch it wrong. So, why does the policy and the impact disconnect? By the time the impact is visible, the policy rates have already moved. If you wait for the macro data to confirm the impact, you're looking at a system which was not where the pipeline or the transmission is supposed to be. And why do markets don't wait for this? So if today there is a rate hike, according to you, markets do not wait for the actual impact. They price the expected future impact. They will start looking for answers to the questions: how long will the rate stay high? Will the inflation fall off? Will the growth slow down? And all that. Markets price the future scenario, not the current event. Remember, markets react to where the rates will eventually move and start to hurt, not where they are today. Perfect? Yes, Priya, correct. So there are few hidden channels of transmission, which is not visible normally. One is the balance sheet. The impact is uneven over there. The high debt companies will get an immediate stress. The low debt companies, there would be a delayed impact. Expectations. Words move markets before actions. If RBI signals are aggressive tightening, the borrowing slows much before the actual hikes. Then there is the currency channel and the asset prices. The reality of this uneven impact all high leveraged companies feel the immediate pressure. Okay, so they will immediate stress on their cash flows and operations. But companies which are cash rich and low debt companies, the impact is there, but it's a much delayed impact. Sometimes, many a times, it might not be even felt even at the margin. So, what are the three things to look forward to as a wealth manager? Simple things. Look for the lag. L stands for look for the policy direction. A stands for try to assess the transmission and try to see the gauge the behavioral shift. So when I'm looking at the policy direction, figure out whether RBI is either tightening or loosening, easing the rate cycle. Are we at the early or the mid or a late rate cycle of the pipeline? Or are loans actually slowing down or spending actively reducing? These diagnostics tells us exactly where we are in the cycle. Okay. So if we have to simplify this, remember, rate changes don't hit the economy instantly. They move through the banks, the borrowers, the behavioral part, and eventually it all happens over a period of time. And only then they do show up in the data. Interest rates don't move the economy overnight. They slowly reshape it over time. All the best, everyone. Have a great day ahead, and I see you tomorrow exactly at 10:10. Bye-bye. Take care.